Futures and options are inherently risky and not suitable for all investors. Only risk capital should be used. An investor may lose more than the original investment. Past performance is not necessarily indicative of future results.
Hi Matt, well here I am again. It's Thursday, March 1st. I've been dealing with a dog market down there for 2 weeks. And when I say dog market, I mean the S&P too. You know I scalp everything, and we're finding stuff, but it's few and far between.
Right.
So I thought I'd come up here and see if you have any thoughts for us. Using options.
Sure.
That's your expertise. So
okay.
What do you have for me?
Well, yeah, we've definitely been dealing with a very range-bound market still in the bonds, as we have been for weeks and weeks and weeks. So we actually saw a little bit of a pickup in the volatility on this down move today. In terms of options, obviously, you should only use risk capital. Okay, you could potentially lose more than your initial investment. Okay, it's not suitable for everybody. Okay, now that being said, today we had a move down towards the lower end of the range, and looking at the June bond contract, we've gone down on numerous occasions and traded, the mid 139s, somewhere in that neighborhood. And I know that you also have 139-ish as one of your levels as well. So that coincides well. And there are two camps right now. Those that think bonds are going to stay relatively range bound for the foreseeable future, and those that think we're setting up for a larger move given the lack of a QE3, at least so far. So but I think a lot of people out there think rates aren't likely to spike too high given the continued unknowns in the Eurozone, Iran, some of the other things going on. Okay, so what I'm going to talk about today is just two different ways you could potentially play the bonds right now if you feel we're likely to go, stay in this range. And looking at this chart, I think that if we get a move down to this support levels, 139, 139 and a half, and you think it's likely to hold, two ways you can go about it. You could look to be a put seller or the seller of a put spread. Now, in terms of being a put seller, something along the lines of the May 135 put, I think would make some sense. The option's got 51 days till expiration. Okay, I would look to sell that option for 45 ticks or better. So we're talking about $703, not including commissions and fees. Now the important thing to remember here is that this is a naked option. Your exposure to the market is completely unlimited. Okay, so you have to have active risk management and really know what you're doing if you're going to trade naked options. Okay. Now, a lot of people out there are not comfortable with the thought of unlimited risk, or they don't have the expertise to be trading naked options. So another way you could potentially look to play it is you could sell a put spread. And in that case, if you think we're going to stay range bound and we're going to hold those levels, you could look to sell the 135 put and then simultaneously purchase the 130 put. Okay, and again, this is May, 51 days till expiration. Now, what you've done is you've sold the May 130, 135 put spread. And I would look to sell that for somewhere around 35 ticks. So you're talking about $547, not including commissions and fees. Okay, now on this position, we're using a 5-point spread. Okay, 5 points is the difference in strikes from 130 to 135. As we know, each point in the bonds is worth $1,000. So the maximum exposure on this particular position is $5,000 minus the premium collected, okay, minus whatever commissions and fees are, okay? And again, because this is a spread, you're going to have not one set of commissions and fees, but you're going to have two. So you always want to factor that in, though, to potential profitability on a position. So that would be the maximum exposure, though. So it's a defined risk position, okay? And these positions can potentially profit if the market rebounds, goes back up into the range, if it trades sideways. Even if the market still moves lower, they can potentially profit. However, in this case, looking at this chart and our levels, I think that we break 139, I'd look to exit a position like this because the risk is really to the downside at that point. So that's two ways to play it.
All right, Matt, thanks.
No problem.